So let's step back a little bit and just look at the overall financial system in which a lot of these securities are traded. And it's basically a circular flow. We have savers, corporations, and individuals that save money. They usually deposit that money in a bank, or they invest in a market, such as a stock in a bond market, or even in a derivatives market. So they have excess loanable funds that they then put into the market or put into a financial institution. Then you have borrowers that need capital. So the market and or the financial institution lends that money out to the borrowers. Obviously the borrowers, the cost of borrowing the money is higher than the return that the savers or investors are getting, and that is called the spread. And the bank or the markets will skim off a certain percentage of that return as management fees for what is called financial intermediation. Okay? And that's basically how capitalism works in a nutshell. The key is, at the end of the day, is really what are the balance sheets of the individuals and what are the balance sheets of the corporation. Okay? So on the liability side, which is really the key side of the balance sheet, is made up of short-term notes and short-term bills. So basically what you're doing is you're borrowing money on the short term to basically finance your short-term assets. And this is basically your operating capital right here. The liquidity that you need to operate and buy inventory and replace it. You also have medium-term bonds that you may also issue 5 to 7 years that are basically going to be invested in mostly equipment. 5 to 7 year equipment with economic or depreciable lives of, let's say, 5 years on average. And then you have long-term bonds and long-term financing, which is your long-term bonds, maybe 7 to 10 or 7 to 12 or 7 to 15 years in maturity. And then you have owner's equity, which is a long-term financing source. So you're going to take these long-term bonds with the debt piece and then the equity piece, and you're going to finance long-lived assets with long economic lives, plant and equipment, usually plant, maybe facilities, real estate that you hold in the portfolio are going to be financed through owner's equity and long-term bonds. The goal of the managing the balance sheet is going to be matching the maturities in what is also called the duration between the liabilities and the assets. So you want to use short-term liabilities to finance short-term assets, medium-term to medium-term, long-term to long-term. Corporations get into problems, and banks get into problems when they use short-term maturities to finance long-term assets, because these are exposed to interest rate risk. So if all of a sudden interest rates move up significantly, more than the return on the assets over here, you have an asset liability and a maturity mismatch. And this could actually cause the financial institution or the corporation to either go insolvent or go bankrupt. Okay? So the overall asset liability management is really to match the maturities, okay, between the assets and the liabilities. And these securities are then traded in the capital markets that became markets for people to buy and sell those liabilities. And then the owner's equity are the stocks that are traded on the exchanges that basically also are backed by the assets of the company. Again, the goal at the end of the day, the game of capitalism, and it is a game, the game's pretty simple. My return on my assets, my internal rate of return, my weighted average internal rate of return on my assets has to be greater than the cost of my liabilities, or what is called the weighted average cost of capital or my liabilities. So the goal is to generate a positive spread and maximize that spread. If you can do that, you win. Your stock price goes up, it maintains its value, you can pay dividends into perpetuity, and you can scale. You can raise capital, you can grow, you can do whatever you want. You win. If your spread turns negative, your stock price is going to plummet and you can go bankrupt and insolvent. Okay? So that's really what financial managers are trying to do, is to invest in assets that are going to generate high rates, risk-adjusted rates of return, and they're going to minimize the cost of these liabilities to maximize the spread. You can, and the spread that I've seen over time, really well managed companies with very low liabilities and leverage can actually be highly profitable for hundreds of years with a spread of only 100 basis points. Okay, so very narrow spread, but very conservatively managed. I've seen other industries of 150 basis points, and tech companies are probably a lot higher than this, but these things are extremely volatile, so the spreads themselves are extremely volatile. It's really hard to manage those types of companies, and hard to measure their success. You can also take the returns on the assets and take the returns on the assets and multiply them by the dollar amount to get a dollar amount of return. You can do the same thing with the cost of capital, multiplied by the dollar amount of the liabilities to get the dollar amount of the liabilities, and you subtract the two, and that's the dollar spread, not the percentage spread. And it is what is called economic value add, okay, or EVA. This is huge. It's not in the book, but it's extremely important to understand because a lot of financial institutions and major corporations really focus on the economic value add that's being created by managing the asset and liabilities of the corporation. Okay, so this is really important, but it's not really mentioned in the book. And then you can also look at the market value. This could be the book value of the assets and the liabilities. This is all reviewed, right? I mean, this is financial accounting, basically. Or you could take the market value of the assets and the liabilities. Same equation, instead of using the book value, you use the market value. When you use the market value, you're not getting economic value add, you're getting market value add. So corporations and the CFOs and the CIOs and the treasurers are really focused on economic value add and market value add, because it's basically the contribution of value to the corporation on the margin. That's the name of the game. You can continue to contribute to the value of the corporation on the margin consecutively over time by managing your assets and your liabilities very well. You're going to maximize the spread, you're going to maximize the stock price. Boom, you win. You can get access to the bond market, access to the stock market, you can hire the best talent, you can expand globally, you can expand in other markets, you can take over your competitors' market share, you can just, you got it, that's it, you win. How are we doing on time? 10 more minutes?
Yeah.
I think we probably won't be able to get into the economics, which is really sets up the memo, but I'll do that on Monday, but let me kind of cut to the chase, you know, in the book, okay? There's basically three approaches. Right off the bat, chapter 2, chapter 3, and then you're going to get into it more and more and more throughout the book. But basically the most valuable components of the book is basically valuation. How do you value an asset? How do you value a security? How do you value a bond? How do you value an investment? If I buy some equipment,